Your 9-to-5 savings are officially losing value faster than you can earn them. Inflation has turned your bank account into a leaking bucket, but a massive market pivot is coming in 2026. Stop hoarding dying cash and learn how to flip distressed digital infrastructure before the window of opportunity slams shut forever. For years, most people believed financial security was simple. Work hard, save consistently, avoid risk, and eventually, life will reward you. But the reality of 2026 looks completely different. The cost of living is accelerating faster than salaries. Artificial intelligence is reshaping the job market, and traditional savings accounts are quietly destroying purchasing power every single day. Meanwhile, a new class of infrastructure-based digital assets is creating opportunities most people still do not understand. And just like every major wealth shift in history, the people who move early usually benefit the most. In this video, we are going to break down why the traditional savings model is collapsing, what the 2026 asset flip actually means, how ordinary people are entering this market with surprisingly small capital, and how this shift could completely redefine financial freedom over the next few years. Because the biggest financial risk today might actually be playing it safe. The illusion of 9-to-5 financial security. For decades, the middle class followed the same roadmap. Get a degree, find a stable job, save consistently, invest slowly, retire eventually. And during the low inflation era of the early 2000s, that strategy actually worked. Back then, the average savings account earning 2 to 3% interest did not look terrible because living costs were relatively stable. But 2026 is not that world anymore. Now think about this carefully. If inflation averages 8% and your savings account gives you 2.5%, you are not gaining money. You are losing purchasing power every single year, silently. That means even if your bank balance goes up, your real wealth goes down. Your cash may look bigger on a screen, but it buys less food, less housing, less energy, and less freedom. And this is where most people get trapped psychologically. They think safety equals cash. But in modern inflationary systems, idle cash becomes a melting ice cube. The danger is even worse for salaried workers, because wages are no longer moving at the same speed as expenses. Rent rises faster, insurance rises faster, utilities rise faster, healthcare rises faster, but most salaries barely move. This creates what economists call delayed financial suffocation. You feel stable, until suddenly you realize your lifestyle is shrinking every year despite working full-time. And AI acceleration made this even more dangerous, because companies are now aggressively reducing labor costs through automation. Meaning, millions of workers are competing for slower wage growth in an economy where asset prices keep exploding upward. That is why the wealthy stopped relying on salaries a long time ago. They focus on ownership. Because labor pays bills, but assets create freedom. The great wealth migration of 2026. Something massive started happening in the background of the global economy this year. Institutional money quietly began moving away from traditional passive investments and toward programmable real-world assets. Not because it's trendy, because it's profitable. The old system was built around stocks, retirement accounts, and long holding periods. But now institutions want assets that are liquid, fractionalized, AI manageable, and globally tradable 24/7. That's why capital is flooding into digital infrastructure ecosystems. Things like tokenized energy grids, AI compute networks, data center micro-ownership, digital twin infrastructure, fractionalized logistics systems, and programmable real-world asset platforms. This is where the average person becomes confused. They hear words like tokenization or digital infrastructure and assume it's another crypto hype cycle. But this is different. The speculative meme era is dying. The infrastructure ownership era is beginning. In simple terms, real-world systems are being converted into digital ownership layers. And once ownership becomes programmable, it becomes tradable. That changes everything. Because now, a retail investor no longer needs millions to access infrastructure-level opportunities. You can buy fractions. flip access rights, trade undervalued infrastructure exposure, and participate in markets that were previously reserved for institutions only. This is the exact reason traditional retirement structures are struggling. Many 401k-style systems were designed for slower economic cycles. But programmable assets move at internet speed. And last quarter gave one massive signal most people completely ignored. Institutional allocation into tokenized real-world infrastructure surged while traditional long-duration bond confidence continued weakening. Translation? Big money is repositioning before the public catches up. And historically, wealth transfers happen during transitions like this. Not after everyone agrees. The mechanics of the asset flip. So what exactly is the 2026 asset flip? It is the process of acquiring undervalued fractional digital infrastructure assets before broader market demand reprices them. Now this is important. This is not gambling on random meme coins. And it is not day trading. The strategy focuses on micro-equity ownership connected to real economic utility. Things like compute infrastructure access, digital energy routing systems, AI processing networks, tokenized storage infrastructure, bandwidth ecosystems, and digital twin property frameworks. Think of it like buying land before a city expands into it. The goal is simple: acquire undervalued infrastructure exposure early, then flip portions during liquidity expansion phases. And the biggest shift happened because of the 2026 regulatory adjustments around fractional infrastructure participation. For the first time, smaller retail investors gained easier access to infrastructure-linked micro-assets that previously required institutional capital or private placement access. That lowered the barrier dramatically. Meaning, someone working a regular job can now start small. Not with hundreds of thousands, sometimes with less than 1 month's rent. That changes the psychology completely. Because now, financial growth is no longer limited to salary scaling. You can build ownership scaling. And ownership scales differently than labor. A salary depends on hours. Assets depend on demand. Executing the rapid growth blueprint. Now let's talk execution. Because information without action changes nothing. Step 1 is identifying undervalued digital twin infrastructure assets before mainstream visibility arrives. This is where most people fail. They buy after social media hype, after influencers talk about it, after prices already exploded. Smart capital moves earlier. You want to monitor developer activity, liquidity growth, institutional wallet movement, infrastructure partnerships, AI integration announcements, and secondary marketplace expansion. The goal is finding ecosystems with increasing utility but low retail attention. Then comes the 90-day cycle strategy. Instead of emotionally holding forever, many modern asset flippers operate in structured rotation cycles. Accumulation phase, liquidity expansion, partial exit, capital redistribution. Repeat. This creates compounding momentum without relying on one massive moonshot. And another key advantage in 2026 is automation. Today there are AI-powered tracking systems monitoring floor prices, volume spikes, liquidity pools, smart money movement, and volatility conditions in real time. Meaning retail investors now have tools that once only hedge funds could afford. This is why the speed of wealth creation accelerated so dramatically. Not because humans became smarter. Because technology amplified decision-making speed, and if used correctly, these tools remove emotional investing from the equation. Protecting your new financial baseline. Now here is where most people destroy their progress. They make money, but fail to protect it. The purpose of flipping assets is not endless speculation. It is building a stronger financial baseline. That means risk management becomes everything. Professional asset operators rarely expose all capital to one ecosystem. They diversify across liquidity levels, infrastructure categories, cash flow assets, and stable reserve allocations. Because survival matters more than hype. And eventually, The real goal is transitioning from short-term flips into long-term cash-flowing ownership units. This is the evolution most beginners miss. First, you build capital through strategic flips. Then you transition gains into assets generating recurring income. That could mean revenue-sharing infrastructure units, AI compute leasing, digital storage yield systems, or tokenized utility networks paying recurring distributions. At that point, your money starts working harder than your job. And that is the real escape. Not quitting work overnight, but reaching the point where your salary becomes optional instead of essential. Because once ownership income covers your core expenses, your entire relationship with time changes. And over the next 12 months, this transition may accelerate even faster. As we move closer to the 2027 market cycle, institutional competition will likely increase. Regulations will mature, and early inefficiencies may disappear, meaning the biggest gains usually happen before the system becomes obvious. That is why timing matters now. The middle-class strategy of saving cash and hoping for stability is breaking apart in real time. Not because people are lazy, because the economic system itself evolved. The people who adapt first usually benefit the most. And in 2026, the biggest shift is simple: labor alone is no longer enough. Ownership is the new survival skill. So the question is not whether the economy is changing. It already changed. The real question is, will you spend the next decade protecting shrinking savings or building assets that can actually outgrow the future? If you enjoyed this video, subscribe to Wealth Sketch for more deep dives on AI, wealth systems, financial shifts, and future-proof income strategies. And remember, the biggest opportunities usually look confusing right before they become obvious to everyone else.